Hello and a warm welcome to a brand new episode of ET Markets Mutual Funds Talk, right here on ET Markets live stream, your own destination to get investing ideas and be a part of discussions that matter. My name is Deepika Dhanda Singh, and today we have with us Mr. Arun Kumar. He's the Vice President and Head of Research at Funds India, one of India's largest digital wealth management firms that has been in business for over 14 years and manages over rupees 10,000 crores in assets. He has 11 plus years of research experience across the wealth management industry. He's also a widely followed personal finance blogger with 10,000 plus subscribers and 6 lakh plus views. Today we will talk about difference between SIP and lump sum investing in mutual funds. This is in continuation of our series on demystifying mutual fund investing. To answer all our questions, I welcome Arun to the show.
Hi, Deepika. Thank you so much for having me on the show yet again.
Thank you for being a part of the show yet again, Arun. What is SIP investing and how is it different from lump sum investing? Also, by what criteria can a retail investor decide between both of them?
SIP investing is a fairly simple approach. Basically, what you're essentially trying to do is to automate your monthly savings, right? So, in essence, most of us end up getting a monthly salary. So, SIP is nothing but you're essentially saying, hey, automatically, can you debit savings from my banking account, and can you invest it in that particular mutual fund that I've chosen, and can you do it regularly? Once I've set it up, I don't want to be involved in the day-to-day hassles. Now most of us will keep it as a monthly frequency, but there are other you can set it up on a weekly basis, on a daily basis. So that is completely up to you. But the essence is that you have chosen your mutual funds and you have told this is the amount that you have to debit from my savings bank account and automatically transfer it to this mutual fund, and you fix the dates and you fix the number of times it has to do over the next 2 years, 3 years, 5 years, and you can also set up perennial SIP. So SIP is mostly to do with how you automate your savings behavior and automatically invest it in the required fund. Now, in terms of lump sum, it is in a way it is very similar to SIP investing. It's just that say somebody is earning 50,000 a month and they can say invest 10,000 every month. Now this 10,000 they can easily automate because they know that every month they are earning rupees 50,000, and so it is fairly they know that this 10,000 they can save every month. Now let's say they get a bonus or they sell some land and then they suddenly get say 5 lakhs or say 1 lakh or say 50,000, whatever be the amount. Now that amount is not a part of the regular SIP which they can automate, because this is something that they did not expect. Now this, when they are investing, this is generally called as lump sum investing. So net in SIP and lump sum, the only difference is that in SIP you kind of know what is the amount, and mostly it is aligned to your regular salary or the cash flows, and hence you automate it and you say, hey, do it without my involvement over a long period of time. Lump sum is whenever you get that extra money that you didn't plan for, or like it is not a part of your regular salary cycle. This, how do you invest this bulk amount that you're getting? This is basically called a lump sum investing. Now, in terms of how do you decide, obviously, if it is a part of your salary and you know this is the amount that's going to come for the next 1 year, 2 year, 3 year, then it's fairly easy to set an SIP and say, hey, automatically take this amount and invest in this mutual fund, even without asking me, because I might be busy in my work. The lump sum is obviously you'll have to take a call individually when it comes. There again, you'll have to see how large is the amount and what is the market conditions at that moment, and then take a call on whether you go all in and then invest everything at once, or you stagger it over a period of time.
All right. What is the process that an individual investor must follow if they wish to invest money through a lump sum amount?
Yeah. So when you're getting lump sum, it's the first thing that you essentially do. So let's take the same example where somebody is earning say 50,000 a month, and they are able to save say 10,000 every month, and then they are investing it in a mutual fund which they have automated through an SIP. And say for some reason, or they had somebody giving them, or they sold their land, or they got a bonus or some ESOP. Let's say they get an amount of close to around 1 lakh at some point in the year. Now they have to take a call. What do I do with this one? The first step is that first you ask yourself, what is the split between equity and debt that you have in your existing portfolio. When you are very, very early, a lot of people are very aggressive and hence they can afford to put almost the entire amount into equity. But as time progresses and as your portfolio size becomes bigger and bigger, especially in relation to your salary. So let's say you're earning, say, 5 lakhs a year, and then suddenly this amount itself becomes 20 lakhs as your portfolio. Then it's a very large amount compared to your salary. So then you might want to safeguard a portion of it using debt funds. So this whole split between equity and debt, obviously initially you are very, very aggressive and you want to have very high exposure to equity, but as your portfolio size becomes bigger and bigger, you also want to keep increasing, or you want to add sufficient amount of debt so that the overall volatility in your portfolio is a little more manageable. Obviously this will have some impact on the long term return, because debt usually gives around inflation plus 1%, while your equities will give you inflation plus around 6% to 7% kind of a return. But the point is that at a larger size, the ups and downs becomes more difficult for you to handle. So to compromise on to reduce that, you're taking a small hit on the long term. So the first question you ask is, how much am I into equity and how much am I into debt? So let's say you are usually 70% equity and 30% debt. So out of this 1 lakh, out of this 1 lakh, 70,000 will have to go into equity, and then 30,000 will have to go into debt. Now for debt, it's fairly simple. You just directly invest immediately. Let's say I got the money today, I go immediately invest that 30,000 in debt. Now the challenge comes with respect to the 70,000. I have already identified my equity funds. Now should I go all in and invest it today, or should I stagger it over some period of time? Now generally, the way to think about it is very difficult to time the market. So which means, in essence, I do not know whether the markets will be down or up in the next 1 year. All I know is that over the next 7 to 10 years, going by history, and if the earnings growth of the Indian companies continue to grow up, generally you end up with very, very good returns over 7 to 10 years. But again, the challenge is you invest now and then it suddenly goes down, then the regret kind of hits you. And so the way to start really thinking about is that you really do not know whether the markets will go up or down. So in essence, you are trying to behaviorally manage yourself so that if you invest now and then if it goes down, it should be okay with you. At the same time, if you keep waiting and then suddenly it starts going up, then that also is another regret that will hit you. So you need to balance both of these. So the way you can do it is, you can take two things. One, you look at the size of the amount that you've got, especially with in relation to your existing salary or your existing annual savings. If it is a very, very large amount compared to your annual savings, then you need to be a lot more cautious, or a lot more risk averse, and then you need to be a lot more slower in terms of deploying that. Second thing is, you look at valuations. If valuations of the markets are very, very high, then you got to be a little more slower and deploy it over a period of time. If the valuations are very cheap, then you can deploy it as fast as possible. Now, with both of these as the underlying two parameters, you can take a call. Generally, my sense is, at max, you can deploy it within 6 months as a general thumb rule, because historically, when we looked at the last 22 plus years, we saw that if you had staggered it over 6-month periods, usually you end up with very, very good returns over 7-year periods. So 6 months, staggering over 6 months seems to be a very decent option. The only caveat that you'll have to add is, if valuations are very cheap, you might want to deploy it all at once. If valuations are reasonable, maybe in 3 months. If valuations are very, very expensive, maybe in 6 months. And if the amount is very large, that is making you very, very cautious and very, very scared, then you can at max extend it up to 12 months, but nothing more than 12 months. So generally, whenever you get the money, debt money, you invest it as soon as possible. Equity money, you broadly take a call based on valuations and the quantum of the amount. My sense is up to 6 months works really well for most of us. Unless and until the amount is really large, you can extend it at max to 12 months. But don't extend it to 2 years, 3 years, 4 years, 5 years, because then you're losing the whole idea of putting your money to work as early as possible. That is making it too long a period. So that's how we would probably want to deploy your lump sum money.
So, in fact, well said. Now, before we sort of go ahead, I'd request each and everyone who's watching the stream right now just say hi, wave at us, and do let us know if you have any questions. We'll take them up with Arun. Now, let me move on to my next question. If the equity markets fall immediately after investing a lump sum amount, what course of action should an investor undertake?
Yeah. So this is always possible because most of us think we will exactly know when the market will fall. And unfortunately, if you look at data, there's been nobody across the world who's been able to exactly tell when the market falls and take out the money at the top and then come in at the bottom. There's nobody who's been essentially been able to do it. Fundamentally, because there are too many moving parts. So if you look at COVID, it was a classic case. Like in Feb of 2020, the markets were probably close to their all-time highs, and in a span of 1 2 months the markets were down 40%. So which means if you had a 10 lakh portfolio, within a span of like 45 days your portfolio was probably at 6 lakhs, right? So this is so the fact that markets can fall any point in time should be a part of your natural expectation. So the fact that once you invest, can it fall? It can. Now if you go by history, almost every year you have a 10 to 20% temporary fall, and then it again gets to recover. 10 to 20% is almost a given. So if you're putting say 10 lakhs, mentally you should be like, if it goes up to 8 lakhs, I should be okay in equities. The other part is that over 7 to 10 years, usually there's one large fall that happens. It can be more than that, but at least going by history, one fall is like you should have it as a part of your expectation, that it can be up to 30 to 60%. So two things that you'll have to think: 10 to 20% is normal, and like the once in a while a large fall is around 30 to 60%. These can happen any point in time. If you're unlucky, the moment you invest, you can probably get hit by a large fall of 30 to 60%. Now how do you approach it? Which is exactly why you have the debt allocation, which I mentioned earlier, which is what people call as asset allocation. Now if you have 30% in debt and 70% in equity, your debt portion remains stable. Your 30% in debt continues to grow probably at 6% 7%, while your 70% which is invested in equities, this gets the hit. Now what people generally do is that now your asset allocation, which was 70-30, suddenly probably becomes 60-40 or probably 55-45, because your equity portion is reducing while your debt portion is increasing. Now one good way to make use of the lower prices in equity is to take some money out of debt and then again redeploy it back into equities at lower levels, which is after the fall. Now the way you can, it is called rebalancing, where essentially you do, now the question is how much to invest, when to invest. You can generally do it over once a year or probably once in 6 months, or if the fall say exceeds 30%, you can do a rebalancing. At 30% fall, if you do the rebalancing, you again take some debt and then move it into equity and make sure that the asset allocation is back to 70-30. So in this way, the 70 which equity, which is become 60 equity, will again become 70, because you're moving 10% of the overall portfolio from debt to equity. So this is one way in which you can take advantage of the market fall. Obviously these are painful times. It might prolong for 1 year, 1.5 years, 2 years, but the point is you are deploying more and more money from your debt to your equity at lower levels. And we have historically seen always the markets have recovered, because over long periods of time markets tend to follow the earnings growth. And as long as a country we are growing and our entrepreneurs are increasing their profits, overall over a 7 year 10 year phase, we will continue to grow. So when the recovery happens, all the amount which is deployed at lower levels will also participate. So you actually take advantage of the fall. So I think if you invest and then it falls, then you have to do the rebalancing activity. And if you're aggressive, you can say instead of 70-30, now I can make it into 80-20. So these are tactical calls that you can take. But broadly, the idea is when the market falls, your debt portion will give you the safety. And if you are able to be courageous and deploy more money from debt to equity, then after a 2 to 3 year period, you actually end up taking advantage of the fall and improving your return. This is how you end up increasing your returns over long periods of time.
All right, Arun, what is the ideal recommended time frame for someone looking to start an equity SIP?
So for equity SIP, we did a small study of the last 22 years. So we first said, what about a 1 year time frame, right? In 1 year time frame, we found that almost 25% of the time you ended up with negative returns over a 1 year time frame. So we said, okay, 1 year is not a great time frame to look at. What about 3 years? In 3 years, we found that almost 10% of the time you still ended up with negative returns. While better than 1 year, but still 10% negative returns is not something that's great, right? Then we extended it to 5 years. In 5 years, the good part was that the negative returns almost became zero. It was around 0.5% was the probability of hitting a negative return. But the point is a return of sub 7%, which is again not something for which you come into equity, right? 7% is what you would probably get in your FDs or debt funds. So that again was close to around 10%. Now, the moment you extend it to 7 years, your odds of 0% return, negative returns was zero. So, which means you always had positive returns. And on top of it, the chances of you getting a less than 7% returns was only 3%. So in our view, if you go by the historical data, obviously the longer the better, but at least a 7-year time frame is what you should minimum have when you are starting an equity SIP, and that's what history tells us. And we have tested it out over. We tested this in Nifty 50 TRI. When we did this in a lot of good mutual funds, the results were even more better. So broadly, the idea is come in with a 7-year time frame, and in the worst case scenarios where the last 1 year you have a large fall, say in the 7th year you have a large fall, we found that if you extended the time frame by 1 to 2 years, the returns significantly improved. While obviously the returns were not really bad, maybe they were between 7 to 10%. The return significantly improved to say about 12 to 15, around the 12 to 15% band as soon as the market recovers. So you need to mentally come with a 7-year time frame. Most likely 99% of the cases it will work out well for you. In the rare case there's a sharp fall, you need to be mentally prepared to extend your time frame by 1 to 2 years. So 7 to 9 years is a very, very good way to approach an SIP investing in equities.
All right, Arun. Now we have a lot of questions coming in from our viewers. Sanjay Kapoor wants to know, is multi-cap fund the best option to invest into the SIP?
See, when somebody is looking at investing in SIP, the first idea is basically to say, are you going for passive investing or active? Now, what is passive and what is passive? Essentially means I do not want any fund manager to manage it. I basically want to go by a formulaic rule-based investing where there is no human fund manager. Everything is taken care by some set of particular rules. Now, passive is generally referred to a common rule which basically says I will put all the companies, say top 50, top 100 or top 500 companies, and arrange them as per size. And the larger the size of the company, the market cap or the free float market cap of the company, you give a higher allocation to them. So overall, it is like buying every company there and then giving it the higher the size of the company, you give higher weight. This is broadly called passive investing. Again, you have factor based investing where you have different rules. Instead of size, you can do it based on you can do it based on profitability, which is quality based metrics. You can do it based on valuation metrics. You can do it based on momentum in stock price. So there are different rules that you can apply. So first you need to say, am I okay to go with rules, or do I need a fund manager to manage my usually in globally you are seeing that passive is making active fund managers are finding it really difficult to beat passive. At least from an Indian context, we are still not yet there. But on the large cap side, we are seeing that passive funds are making a lot more sense compared to active funds because of two reasons. One, almost all the large cap fund managers, if you look at it at an aggregate, 60% of their portfolio is very similar to the passive benchmark index. So with 60% similar portfolios, you only have 40% left to give you that outperformance. And on top of it, you have a higher expense ratio. So net, when we work the math out on that 40% portion, every year you almost have to outperform by 5 to 6% to get the 1% outperformance at an overall portfolio level. So 5 to 6% outperformance on a 40% part of the portfolio every year is a very, very hard task. So my sense is passive makes a lot more sense on the large cap side. On the mid cap, flexi cap, and small cap size, active still makes a lot of sense on the for the Indian markets. Now, in terms of how to select these funds, if you're going by passive, then you start with Nifty 50 as your starting point. Then you add Nifty Next 50, which is the next 50 largest companies, and then you add the mid cap 150. Now you can club these three together, and if you want a global allocation, you can add US S&P 500. Now you can equally split amongst these four or these three based on whether you want US or not. So this is on the passive side. On the active side, multi-cap funds will give you exposure to large cap, mid cap, and small cap. Now you can take it you can do it yourself also. You can say I will do based on styles. You can do one, quality as a style. You can do value as a style. Three, you can do GARP, which is growth at reasonable price or blended as a style. Fourth, you can do mid caps and small caps as a style. And fifth, you can do global as a style. Now, if you combine all these five together, you will ensure that all the different styles which have proven to work across the world, you have it in your portfolio, and there's a good fund manager managing it. Now, the key point in active fund management is that all fund managers will go through their underperformance phases. Now, if you buy into, say, multi-cap funds and then say it is that those funds are aligned to a particular style, then there'll be periods where they underperform and you will find it really difficult to hold on to them. Now, if you mix and match these styles, just like building a cricket team, right? You have different players with different talents, and in each and every match you find that two or three shine and two or three don't do well. That's exactly the way you find different investment approaches, combine them together. So as I told, if you put these five styles together, then it will work out well. So multi-cap, while it's a good option, make sure that you're blending different styles, especially these five styles together. So overall you'll get so overall you choose whether it's passive or active, and then you take a call on, within active, diversify across styles. Within passive, just make sure you are Nifty 50, Nifty Next 50, and Nifty Mid Cap 150, and a global fund, so that you are across the spectrum.
Sanjay, I hope your query has been solved. Now, the next question is how to hedge against market falling in the year when I need money, say, after doing SIP for 5 to 7 years?
Yeah, so in essence, so let's say if you have a time frame of, say, let's say your goal is coming in 10 years. Now, most of us, what we do is we exactly plug in 10 years and then say what is the amount required, and then plug in, say, 12% return expectation, and we calculate what is my SIP amount that I have to invest in. My suggestion would be that always keep a buffer of safety. So if your goal is at 10 years, you assume that you will have to get that money by 8 years. So instead of plugging in as 10 years, you plug in for 8 years, and then you calculate saying what is the SIP. Now, obviously, for 10 years, if it requires, say, 10,000, maybe for 8 years, it might require 12,000 or 13,000. But that's still fine, because you are giving that margin of safety of what if there is a large fall in that last 3 months or 6 months of your SIP journey. So this is one approach. The other approach is where, so now once you have built the buffer, you check by the 7th year or 8th year, are you close to that amount? If you're close to that amount, you take it out and you put more of the amount into a debt fund and then safeguard it. Or the other approach would be that whenever your goals are coming, you put a time frame saying 2 years or 3 years before that, you stop your SIPs going into equities, and then you deploy it into a balanced advantage fund or a debt fund. Now, this, whether balanced advantage fund or a debt fund, will depend on whether the goal is flexible or non-flexible. So let's say the goal is to buy a house. You can probably extend it by 1 year, because there's no particular timeline which is very, very critical. But let's say if it is for the education of, you have to pay the college fees. Now, these are non-negotiable, right? So you need that money on that particular month. So in those cases, you need to be a little more safer. So you stop your SIP by before 2 years or 3 years, and then the incremental SIPs goes into a debt fund. For whatever you have collected in your equity till date, do a reverse, do an STP into a debt fund, and then move that money slowly into another debt fund. So basically, it means for your 10-year goal, you essentially do an SIP into your equity probably for 7 or 8 years, and then starting the 7th or 8th year, incremental SIP goes into that debt fund, and whatever amount you have collected into your SIP into your equity fund, you do a reverse monthly, small amount gets feeded into your debt fund, so that at the end of 3 years, the money collected in your equity fund goes to your debt, and your incremental money is also in your debt. So in this way, you are ensuring that even if the market behaves, there's a large crash in the last 1 year or last 6 months, most of your money is safeguarded, and the impact of markets going up and down is not too high on your portfolio. This is how you can plan for the exit.
Now, next question's from Swarna. She wants to know, for how long should we stay invested in liquid funds?
See, liquid funds are essentially it is more like your savings bank account, right? They, within the debt funds, they give you the lowest returns. But again, the point for which liquid funds are mostly used is it's like a temporary parking lot. So let's say I have a 1 lakh commitment in the next month, and I have that 1 lakh in my SB account, and I want maybe incrementally some small extra returns. Then I park it in my liquid funds for the next 1 month, and then as soon as I need it, I take it out. And usually people also put their emergency funds there, so that as and when you need it, you can immediately, because one, liquid funds are supremely safe. Most of the liquid funds, if you take any top 10 large liquid fund, they're reasonably safe. They're all invested into very high credit quality companies, or basically they lend to very high credit quality companies, and they lend for a very very short time frame, which means the volatility is barely there. So liquid funds are generally used for temporary parking lots, so there is no time frame attached to it, and you can think about it like a savings bank account. And most of the treasury funds, right, the companies have large treasuries which manage their sizes of 100 crores, 1,000 crores. So for them, even a small increment in their returns make a huge difference. So thereby they use liquid funds as a parking lot for maybe 3 days, 4 days before, let's say, giving you your salary. The company might say, for the next 3 days, let us park it in a liquid fund, and as soon as I need to pay the salary, let me take. So mostly corporates and individuals use liquid funds for temporary parking thing, but these are not so anything that require you, if you have a time frame of more than 5 years and you're looking to increase your returns, then liquid funds are not the ideal place to be. Liquid funds are just a temporary parking lot kind of a thing, or for emergency savings purposes.
So I hope, Swarna, your query has been solved. Now, coming to Sandeep's query, he wants to know, should one invest in FD or debt funds today?
See, if you look at debt funds currently, most of the debt funds at 2 years, 3 years maturity, or there are also target maturity funds where you kind of precisely know what is the time frame, and roughly you also know what is the expected return, more or less to a large extent, because there's something called YTM. You subtract the expense ratio from the YTM, and if you hold on till that duration date, you will more or less end up with returns close to that. Now if you look at those returns, they're somewhere close to around 7% in debt funds at the current juncture, even if you go for target maturity products, or if you go for a 2 year 3 year duration funds. And the good part is that over and above the 7% returns, if the interest rates start to fall in the next say 1 year or 2 years, in debt funds there's a kicker that happens, because whenever interest rates fall, you have a one time kicker in returns, and whenever interest rates go up, you have a one time detraction in return. Now mostly the scenario looks like the interest rates will probably stick on to these levels, or can also probably fall from these levels. Now both ways, you end up with around that 7% returns, and with the extra kicker that if returns if the interest rates fall, you can also end up having more returns than that. Now this, you again, you have on a 3 year basis, you have a taxation advantage, as we discussed earlier, that you there will be indexation benefits. So which means whatever is the return that you made over and above inflation, only on that portion you have to pay a 20% tax. Within 3 years, the taxation is very similar to FDs, where you have to pay the taxes similar to your tax bracket. But if you are holding more than 3 years, my sense is debt funds at this current juncture can give you better returns than FD. But if you are looking at a 1 year time frame, then purely you compare the YTM minus expense ratio of the debt fund with your FD rates, and then the tax is anyway the same. So if you most likely the if you see, most of the bank FDs are between 6.5 right now. So you can compare it, you will get that 0.5% kicker. But again, it's a call that you can take, because that 0.5% for a lot of us not might be the a big difference. But if you are having a time frame of more than 3 years, my sense is debt funds make a lot of sense. But if it's less than 3 years, you can just do the math and see if that really makes sense. Otherwise, you go for what is comfortable. While debt funds obviously will give you slightly extra returns, but a lot of us feel a lot more comfortable with FD. So within 3 years, my sense is don't overthink it. Whichever is comfortable to you, looking at the returns, you take a call. But over 3 years, debt funds definitely make a lot of sense at the current juncture.
I hope, Sandeep, your query has been solved. Now, moving on to my questions, Arun, my next one to you is, how can an investor choose funds for building their equity SIP portfolio?
Yeah, so equity SIP portfolio, as I told, you'll have to first take a call whether it is a passive portfolio that you want to build or an active portfolio. In passive, you start with Nifty 50, then you overlay Nifty next 50, which is the next 50 companies. So in net, you will get the top 100 companies of India in terms of size. Then you add the layer of Nifty mid cap 150. So we've also seen that mid cap funds end up giving far better returns over 7 to 10 year time frames. In fact, over 10-year time frame, they've always ended up outperforming a large cap fund because SIP benefits from volatility. So the more the volatility of that particular segment, and on top of it, mid cap funds also end up with slight extra returns over long periods of time. So this becomes a very good combination for SIPs. SIPs, you essentially need something which grows and then something which is more volatile. So mid caps take both of these. This grows over long periods of time and it is far more volatile than large cap. And Nifty Next 50 also suits the same bill. So for an SIP, for an Indian equity portfolio, you put Nifty 50, Nifty Next 50, and Nifty Mid Cap 150. Split it one third, one third, one third. If you also want to add a global, you add S&P 500, or if you want it to be more aggressive, add the Nasdaq 100, and you combine it as a force fund portfolio. If you are looking at active funds, then you have to go by the 5 styles that I told, which is you pick a quality oriented fund, you pick a value oriented fund, you pick a growth at a reasonable price or a blended style fund, and then you go for a mid and small cap fund, and then you go for a global fund. You combine all these 5 together, you will ensure that while 2 or 3 funds will go through bad times, the other 3 will more than compensate for that, and you hold on for a 7-year time frame, you will end up making very good returns. So on one end, you have passive options. Second option is to go for active. Now you will have to take a call which is behaviorally suitable for you. If you want to outperform or at least have the potential to outperform, you need to go for active. If you're saying, hey, I find it really difficult to figure out which is the fund manager, I can't do all these, then you say, I will just go for some plain rules which says I will do everything in the from highest to lowest and then broadly allocate it accordingly, and this I want somebody to automate it for me. Then passive is the way to go, and different people will have different choices. And if you're confused even between both, then do 50-50 of both of these. But again, it just complicates your life a lot. But my sense is stick to one and then let it run for 7 years. Net you will end up with a very, very good outcome.
All right, we have another question coming in from our viewer. His name is Sagar. He wants to know an SIP of 8K or a yearly lump sum of 1 lakh, which is better?
Sorry, can you come again on that? I missed the question.
Yeah, an SIP of 8K or a yearly lump sum of 1 lakh, which is better?
Yeah, see, if you have, say, 8K every month coming in, then obviously an SIP of 8K is better. Now, if your question is that I already have 1 lakh today, then again, we'll have to go back to the question saying that, how do I deploy it? So now the 1 lakh, you'll have to first take a call saying, what is your equity allocation? What is your debt allocation? So let's say if you're 70% equity, 30% debt, out of 1 lakh, 70,000 goes into equity, and then again 30,000 goes into debt. And for that 70,000 at the current juncture, because the valuations are slightly on the expensive side, stagger it over a 6-month time frame. So 70,000, you split it into 6, and then you stagger it over a 6-month time frame. So this will be the way to deploy it. Now, if the other question that you're probably asking is, I don't have that 1 lakh now, but I'm asking saying for 8,000, let me save it in a liquid fund or my savings bank account, and at the end of a year, put it as 1 lakh. You don't need to do that. The better option is to directly go invest 8,000 every month in your SIP. There's no need to accumulate and then make it into a lump sum, because the idea of lump sum SIP is that it helps you avoid the need to time the markets, because SIPs benefit when markets fall. So if you're an SIP investor, you have to pray that the markets fall, because what happens is when the markets fall, you end up adding more units of your mutual fund, and when the market recovers, those more units participate. Now think about it like buying a gold, right? Every month, let's say you are buying, say, 10 grams of gold. Suddenly the gold prices come down, and every month you invest the same amount. Now you suddenly, instead of 10 grams, you get, say, 12 grams or 13 grams. Now you are happy, right? You're not saying, hey, market prices have fallen, gold prices have fallen, and hence I will stop investing in gold. Now your sense is that anyway, gold prices will go up. So I am only want to accumulate more and more grams of gold. So if you really look at the way we talk, even for marriages and all that, it's always on the grams of gold that you give. Nobody talks on the value. So similarly, in equity mutual fund, it's the same concept. What we completely understand in gold, we somehow miss it in equities, because net the worry is that what if equity markets don't go up? We only get news on markets falling, but over long periods, in fact, the last 20 years, the markets are almost up 23, 24 times. Look at the Nifty 50 or the Nifty 500, right? And a lot of mutual funds, decent funds, are almost up 40 to 45 times. So net over long periods of time, market grows. So the more and more it falls, your SIP works well. So if you have the 8,000 rupees coming every month, invest it via SIP and don't convert it into a lump sum at the end of the year.
All right, before we move ahead with our conversation, I'd request all of you who are watching this stream, do hit the like button, follow Arun on our page. Moving on to my next question. What are some of the behavioral pitfalls that the SIP investors must be aware of?
Yeah, so see, the biggest behavioral pitfall is very simple. Now, I've told you that hold for 7 years, you pick these funds, whether active or passive, based on what is your comfort. Now, all of us think, okay, we have to get that 12% plus kind of returns, and then you come in. And then after 2 years, 3 years, you suddenly look at your SIP returns and it's probably only 2% or 3%. And then you are like, why this doesn't work? And then you stop your SIP, or you take out the money, or probably you pause your SIP. Now, what people don't tell you is that if it was so easy, everybody would have been only SIP investors. Just like everything else in life, there's also a pain which is involved, and this pain is very acute in the first 5 years. Now, I call it the dip. Okay, so for becoming a good SIP investor, you also need to handle the dip. Now, what is dip? D is one phase is called disappointment phase, which is probably in the first, after 1 year, 2 year, 3 year, or 4 year. We don't know the timing, but you will go through a phase where your returns are between 7 to 10%. Now you are like, hey, I expected far more. This is not the reason why I came to equities, but it's still okay. It is at least better than FD. So, but while I am disappointed, it is still okay. So most of them survive this phase. Few people get so disappointed they leave, but most of them survive this phase. The second tougher phase is the irritation phase, where the returns are between 0 to 7%. Now you're like, hey, my FDs would have done better. I waited for 3 years, or I waited for 4 years. My returns are only 5%. Now, why did you ask me to do an SIP? So I am stopping this. So this, most people end up, at least 50% of the people end up stopping their SIP during this, or they pause. They're saying, I am not putting any more. At least let me wait for some more time. But if this doesn't work out well, and this phase might prolong for 6 months, 1 year, we do not know. The third phase is a panic phase, where like the amount is lesser than what you invested. So let's say you invested 2 lakhs over 3 years. The amount is probably 1.9 lakhs or 1.8. Now you're like, whatever amount invested, I have not even got FD returns, and I have not even got my original money back. So this phase, most of them stop, take out the money, or they pause. Now this is the panic phase, right? So all these three phases for sure will happen in the first 5 years, and even after that they might happen. But the point is, why does this happen? Mathematically, it's very simple. Any SIP return, let's say even if you have 15%, 12% return over a 3 year, and then in the third year, there's a 20% or 30% or a 40% fall, which happens. So COVID happened, right? 40% fall. If that happened for next 1.5 months, suddenly your returns probably dips to 1%, 2%, or even negative. Most of the SIP returns were negative during that COVID. And post that, they suddenly went back to 15, 16, 17%. Now, this is intuitively difficult for people to believe, because what is at -2, -3? How can it go to +15, +16? Because the same maths works both sides. When a 20, 25% fall hits your SIP, then it deteriorates the return. But if you don't stop, which means you are accumulating more and more units, and in fact higher units at the market fall, and you wish that it continues for at least a 1 year, 2 year time frame, because you are accumulating more and more. And when the recovery hits, all the extra units and your original units start to recover. So the same thing which brought your returns from probably 15 to say -5 or something will again take your returns from -5 to probably back to 16, 17. And this time it will be even more higher. Very, very counterintuitive. So what we have done is at our Funds India portal, there's something called evidence-based lab, where we have given the last 22 years of different SIP journeys. Had you started in Jan 99, Feb 9, so different months had you started, what was your 1 year, 2 year, 3 years? So you can see those dip phases and how it sharply recovers. So this is very, very important. So if you're coming to SIP, mentally it is a guarantee from my side that you will definitely go through one of these three phases in the first 5 years for sure. If you are going to stop or pause your SIP, then your SIP won't work out over a 7-year time frame. So be mentally convinced and go through all the research that you want to do before you start your SIP. But once you start, then you start doubting, saying, hey, am I doing something wrong and all that? Then most likely you'll end up with a disastrous experience because you've wasted 3 years. On top of it, you stop. So the real reason why an SIP works, or the period where an SIP works, is in the dip, and you stop your SIP during the dip, and then you, after 5 years, you find that the returns are not great. You had a bad experience, and you are permanently out of it. So do all the research before this thing happens. And if you're only convinced, you comment, because this is the pain that you have to take. There's no everybody takes this pain, right? Now, if you don't want the pain, then please don't comment. But if this pain is 100% okay for you, get in and handle that. And for 7 years, if you can survive this, you will end up with very, very good outcome. So this is the actual reality. So you have to be okay with both sides of the coin.
All right, Arun. Now we have more questions coming in from our viewers. Sandeep wants to know, how do you diversify your investment within debt funds?
So within debt funds, usually my sense is there are two parameters that you broadly have to look at debt funds. One is net in debt funds. What you're essentially doing is you are lending your money out, right? Technically, while we say investing in debt funds, what you're essentially doing is, if you're investing 1 lakh, you are actually lending your 1 lakh to a lot of companies or the government there. And you are doing it indirectly because there is a mutual fund in between who collects the money from you and all of others and puts it together, and then borrow and then lends it to these companies, or the government takes the interest from them, the borrowing, whatever the borrowing rate that the government and the companies pay, they take a cut out of that, and then they pass on the remaining to us. So first level is that I need whenever you're lending money to, let's say you're lending let's say 10 lakhs to your friend, the first question you want to know is your friend doesn't run away with it. So this is technically called credit quality, whether your friend will return your money back to you or not. So in a debt fund parlance, they call it credit rating. So if it is AAA or government related securities, then it is a highest rating. There are agencies called credit rating agencies, which like ICRA, CRISIL, which rate all the companies. So for all the companies in your debt fund portfolio, you will get how much is highest credit rated now. So check for AAA and government oriented securities. If it is above 90%, then it means you are lending to a good, then you're giving it to a very, very high quality debt fund. So that's the first check that you. Second check you do is, how long are you lending it out to? Now, if you lend it out for a very, very long period, generally it is measured by modified duration, which means that if you're lending it for a very long duration, then your portfolio will also be a lot more volatile. If the interest rates go up, then your portfolio will take a small hit. If the interest rates go down, then your portfolio will have an extra kicker. So usually people tend to go high on duration when interest rates are expected to fall, and vice versa. But these are very complex for a lot of us to do. So my idea or my suggestion would be that stick to funds which are less than 3 years in duration and hold for at least 3 years, so that you get the tax advantage, and you go into high credit quality funds, and you stick to funds which have a modified duration of less than 3 years, and predominantly stick to large sized funds. So at least say emphasize on at least 5,000 crores, and you stick to the top 10 AMC. So if you follow all this, you can reasonably get a very, very good return experience from debt, which is generally your expectation post tax can be at least 1% over and above your equivalent FD returns.
All right. I hope, Sandeep, your query has been solved. Now, moving on to the last question of the show, Arun. Which frequency of SIP is best? Daily, weekly, or monthly? Is there a way to fasten the process of reaching your SIP goals?
Yeah, so this is a common question that we get. So what we did was we also wrote a blog on this. We tested for different frequencies: daily, weekly, monthly. We looked at 10-year returns. Then we again looked at 15 years. Then again we looked at 20 years. And we found that there's hardly any difference in the SIP returns over long periods of time between a weekly or a daily or a monthly. So my suggestion would be, don't break your head on this. The returns were in decimal points, and there was nothing. And sometimes it was weekly, which was getting 0.01 extra. Sometimes it was monthly, which was giving 0.01 extra on a different tenure. But broadly, the idea is that the difference is is barely noticeable. It's in that second decimal point level is the difference. At max, at 1 or 2 decimal points is what is the difference. So which means my suggestion would be that generally do a monthly SIP, because it's simple. The moment you get your salary, there's a lot of temptation to spend it off. So keep your SIP date as close to your salary. If you're getting it on first, then do your SIP on second or third, so that the money is taken out before you even realize. And don't complicate your life doing the weekly or daily, because again, while filing taxes and all that, it adds to a lot of complexities, and for no gain in return. The returns are precisely, it's almost the same, and in fact in some cases the monthly was slightly ahead, right? But ahead in the sense like it was too small, right? You won't even notice the difference after 10 years. So my sense is, go for monthly, keep it as close to your salary date as possible. The second question is, how do you fasten this process? See, net, there are only three parameters or three buttons that you can change for your SIPs, right? One is your time frame. The second knob that you can change is your one is your time frame. The second is your returns, and the third is your SIP amount that you invest. Now, obviously, if you want to reduce your time frame, the other two knobs will have to be changed, which is your returns and the amount that you invest every month. Now, returns obviously is not under our control. Broadly, on an equity, the reasonable expectation that we can probably have is somewhere around 12% plus over a 7 to 10 year time frame. But can you make it 20? Can you make it 25? This is completely not under our control. You get 15, like it's up to the markets, right? So which means that you don't have too much control over this parameter. Obviously you can pick funds and all that, but still this is something which is not really under your control. So the only knob which is under your control is the amount of investments that you do. Now the mistake that a lot of us do is we start setting our SIPs based on our existing salaries, but we forget the fact that every year our salaries also keep increasing. So the key thing to do is, if you increase your SIP amount in line with your salary, say you are growing your salary by 10%, now you also need to increase your SIP by 10% every year. Now, for just to give you an example, if you're doing a 10,000, if you're doing, let's say, a 5,000 rupee SIP over a 20-year time frame, you end up with close to around 50 lakhs, right? Without increasing anything. Now, if you increase your 5,000 SIP by 10% every year, after 20 years, you end up with almost double the amount. You almost end up with 1 crore. So, which means on a 20-year SIP basis, if you are increasing your amount every year by 10% as soon as you get your salary, then it means you almost double the amount. So what was supposed to, or let's say you take the other way, saying this is my goal and I want to reach it faster, what would have taken you 20 years would probably only take you close to 15 to 16 years. So roughly around 16 years you will end up hitting. So you are ending up saving 4 years by increasing your SIP amount every year. So the key thing, the only way in which you can fasten the process is to increase your SIP amounts every year as soon as you get your salary hike.
Well, on that note, thank you so much for your time. And well, that's all for today. But do keep